My name's Ethan Braid. Today we're going to talk about retiring exclusively on dividends. Look, there's a lot of bad advice out there these days about dividends and dividend portfolios. I'm going to show you what's realistic, what you can realistically expect from an all dividend portfolio in your retirement. We're going to take a look at some of the more popular dividend paying ETFs, and then I'm going to show you some of the pitfalls that you can get into with an all dividend retirement strategy. Keep in mind that I'm not a paid promoter. I have no products to promote. I'm just an advisor with over 25 years of experience. Here is an example dividend portfolio using all ETFs for simplicity's sake. iShares High Dividend, Spider High Dividend, Schwab High Dividend, S&P 500, and Vanguard High Dividend. I've evenly weighted these 5 investments. Here's the corresponding trailing 12-month dividend yield, and here's our average yield on the whole portfolio and what we would expect for income dividend yield over the next 12 months. 3% is about what you should expect from an all dividend retirement income stream. Look, there are a lot of bad videos out there, people talking about 5%. I guarantee you that none of those people have been through a real recession. They're probably under the age of 40 and they don't know what they're talking about. If you are trying to plan on much more than 3%, there are a number of ways that you can get into trouble and it can hurt your retirement significantly. Here is an example of what you do not want to buy for an all dividend retirement income strategy. This is the Eaton Vance Tax Managed by Right Fund. This is a closed-end fund and they write covered calls to generate income in this fund. Has an outstanding distribution yield at 8.81%. But let me show you why you do not want to buy something like this. If you had invested $100,000 in the Eaton Vance Covered Call Fund back in 2005 when it was launched, your $100,000 of principal today would be only $64,000. Your income in the first year was $9,500 back in 2006, the first full year of distributions. However, your income as of 2023 was down to $5,694. So your income has decreased by 40% over the last 19 years, and your principal has dropped 36%. That sounds like a really bad deal to me in a time period where we've been in a tremendous bull market for stocks. Using covered calls to generate income in retirement is a really bad idea. You don't get any growth of your principal. You give up your upside, and you're only going to hamstring yourself with these types of funds. If it sounds too good to be true, it generally is. Any dividend strategy that's at 5% or higher is probably overpromising and going to under-deliver. Most likely, your principal will not grow or even decline throughout your retirement, and your income stream also may diminish over your retirement. Let's look at a realistic dividend yield for a fund that has worked over the last decade plus for a dividend strategy. This is the iShares High Dividend ETF. The fund was launched in the spring of 2011, and we're looking at the yield, the dividend yield of the fund over the last 10 plus years. Notice that the average has been 3.26, and it's been fairly consistent in this 3 to 4% range over the last decade plus. If you had invested $1 million in HDV 10 years ago, your initial dividend would have been $34,893. 10 years later, your dividend has grown to $55,423. And I'm assuming in this illustration that you are just spending the dividend, no dividend reinvestment. Meanwhile, your principal of $1 million 10 years ago has grown to $1.4 million. The dividend yield has averaged 3.55% over the last decade. We see a similar pattern with the Schwab High Dividend ETF. Notice that the average has been 2.78% since inception. Vanguard High Dividend ETF has had a fairly tight range for yield over the last 16 years with a 2.94% average. Here's a look at the yield on the S&P 500 SPY ETF over the last 3 decades, 1.74% average yield. The SPDR S&P 500 High Dividend ETF has had a fairly consistent dividend yield over the last 7 years, 4.22% average. If you want to grow your income stream in retirement and have inflation protection and also grow your principal, then you're going to need to look to high quality indexes and ETFs like the list that we're looking at here. Your expectation should be something around a 3% yield. And as I've shown in the previous slides, that 3 to 4% yield has been in place for quite some time. When you start looking for yields much beyond 5%, now you're looking at investments that probably won't give you much appreciation, if any at all. And your inflation protection might be very limited when it comes to the dividend. Now let's talk about some potential pitfalls of an all-dividend retirement portfolio. The first pitfall is that using an all-dividend strategy means that when you retire, if you're only spending 3%, you're probably going to need more capital, more money in your portfolio to generate the income stream that you need in retirement. So you're going to have a lot of money. The second pitfall is that there can be time periods where your dividend income stream may come down, like it did in 2008 when dividends for the S&P 500 came down 25%. It took about 4 years to recover that income loss. The third pitfall, and probably the biggest, is the volatility associated with an all-stock, i.e. all-dividend portfolio. If you had invested $1 million in the year 2000 in the S&P 500, 13 years later, your million was still $1 million. And along the way, you had 2 very significant market drops. So the question becomes, can you tolerate significant losses in the stock market using an all-dividend retirement income portfolio? Not many people can. Watching their retirement nest egg come down by 50% or more when we're in the next recession is really uncomfortable, probably too uncomfortable for most retirees, and they just can't handle it. Bear markets are part of the business cycle. This is a graph of the S&P 500 back to inception in 1957. A very clear pattern emerges. Boom, bust, boom, bust, boom. It's not a question of if, it's only a question of when will the next long-term bear market arrive, like we had from 2000 to 2013 or 1968 to 1982. So let's sum it all up. In the long run, dividends are an excellent inflation protection income source and tend to be much more stable than the stock prices in the stock market. The long-run growth and stability of the S&P 500 dividend is remarkable. 5% growth over 123 years. But to live exclusively off of dividends, you're going to need a tremendous amount of capital and a lot of resolve when it comes to market drops. You cannot get out of the market when the next crash comes. You have to stay invested. In general, the higher the dividend yield, the lower the inflation protection and the lower the opportunity for growth of your principal. 3% is a very good planning number for an all-dividend focused retirement income strategy. 3% gives you balance, it gives you money now, and it also gives you the opportunity for inflation protection, growth of that dividend stream, and growth of your principal. Avoid covered call strategies and investments with yield that sound too good to be true. If the person that you're taking advice from is under the age of 40, they have not been through a recession. That's important, and you want to take note of that. When we get in a recession, how you will feel about watching your investments in an all-dividend portfolio come way down in value is going to weigh on you like a coat of bricks. So it's really important to consider that. I can't stress it enough. Will you react and sell your investments at the bottom, as so many people often do? Be prepared for the volatility. You have to be mentally ready. As I've said before, everybody's tough till they get punched in the face. And when your portfolio drops significantly because we're in a recession, it's like getting punched in the face. You want to be ready now. If your budget can tolerate 3% spending off your portfolio at the onset of your retirement, and mentally, you're strong enough to withstand significant volatility of your investments, an all-dividend strategy is a great way to grow your wealth in the long term and leave a legacy for your beneficiaries. It's an excellent strategy, but it's not for everybody, that's for sure. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.